Let's do our 11 o'clock update. As of right now, the S&P 500 is only down 0.808%. The Dow Jones is only down 0.19%. And the NASDAQ is up 0.15%. These are very low numbers, which means the market is in a mixed market, basically called indecision. Another way we can tell is to go to an index called the BKX. It's the Philadelphia Bank Index. The bank index tends to tell you how strong the economy is, and if the index is going down, the market will probably follow. Next is the XOX. The SOX is the Philadelphia Semiconductor Index. Semiconductors are a very important component of electronics. If the semiconductor index is going down, then that means sales of electronic devices, which drive our economy, is also going down, which should bring the market down. And then we have the XBD. That's the Securities Broker Dealer Index. Securities brokers make their money through buying and selling stocks. If they are making money, then their index is going up. If the index is going up, then the market is going up. Whenever you have a discrepancy, 0.4% here, down 0.04, down 0.41, the market is usually in a sideways trending battle. The next thing to look at is the VIX. The VIX is a fear index. The higher it is, the more likely people are afraid. It's also a volatility index. Basically, the market is very volatile when people can either go up or down at some magnitude. Typically, down is the faster magnitude, so you always want to see what the VIX is. Then we have the TNX. That's the Treasury Index. Right now, it's at 26.43, but you can look at it as the 10-year Treasury note will return a 2.643% return. 2.6 is not the magic number. The magic number is 3.0. So if you ever see this get to 30, then it's most likely that people will want to buy bonds instead of stocks. If that happens, then the stock market will start going down. Another good way to think of this is if the TNX is going down, as in the value of the TNX is going down, then that means stocks are most likely rising. Then you have crude oil. It tells if the dollar is getting weaker or stronger. You have gold. You can tell whether the dollar is getting weaker or stronger on here. You have the euro. Another way to tell if the dollar is getting weaker or stronger. And then the yen. These are currency pairs. The reason you look at these is if the dollar is getting stronger, it takes less dollars to buy the same amount of stock. And because of that, the stock prices actually go down. It doesn't mean that the company is worth less. It means that the dollar has gotten stronger and the value of the company in dollars is less, which still means you can make money selling or buying respectively. And then my favorite, the advancers, how many stocks are advancing in the New York Stock Exchange versus the decliners, how many stocks are declining in the New York Stock Exchange. This gives you great insight into exactly what people are focusing their attention on. As of right now, 1,630 are going up and 1,123 are going down. What you do is take a ratio of advances to decliners, and so that 16 divided by 11 gives you probably about 1.3 ratio. When the market is really moving, that ratio is 2.1, 3.1 to 1, sometimes 5 to 1. So when you see something like 1 to 1, it typically means the market is in a sideways movement, which has confirmed a lot of what we've already seen. The next similar concept is how much volume is going on. Right now, there's 111,000 shares for up volume, and you in the NYSE, and there's 89,000 going down. Once again, if you look at that ratio, that's about 1.4 to 1. Rough math. The trend, the more it's above a 1 is a bearish sign. The more it's below the 1, like a 0.89, 0.69, is a bullish sign. It's basically price change divided by volume change in the market. If the price is going up and the volume is going up, chances are you have a strong market. And then that's how I review everything in the market. Then, just to be sure, I pull up my chart, I switch over to a daily view, I maximize it, and I look to see what the technicals are saying. And as of right now, what we are noticing is that, get a drawing on here, trend line. We're noticing that the market was in a downtrend that went from the top line to the bottom line. And then it broke through that downtrend over here in February. Now we are in an uptrend that started late December when the market dropped and then bounced. And now this uptrend is very sharp. The interesting thing about a sharp uptrend is that the likelihood of it turning around and shooting down is very high because there was too much what they call irrational exuberance driving the market back up. Then if you look, the downtrend is being retraced. There's a possibility that it'll at least pull back a little before it keeps going up. Then I switch to the 60-minute and see what that's doing. The uptrend lines are still holding. There are some dotted lines on here. I'll talk about those later. They're still holding in a bullish pattern. So if I had to honestly assess the market, I'd say it's still in a bullish trend with the high likelihood of a pullback before it makes another bullish push to the top. And then to get a little bit more granular, if I was day trading, I'd pull up the 5-minute and see exactly what's going on there. And as you can see, it's a little bit lower than most of the lines I've added on this chart. And as long as it stays there, then I'll have a daily bearish focus. But as of right now, sideways is the name of the game. And I'll talk about how you can make money in sideways markets in another video. Thank you for listening, and we'll do another 9:30 assessment tomorrow.